gold ETF seeing massive inflows. The Spider Gold Trust, this is the biggest gold ETF, the bullion ETF. It's up 33% this year. Now the sixth largest ETF in the United States. Who would have thought, Jan? And you're very involved in this whole business. You have a bunch of ETFs around gold, including the gold miners. But I want to bring up your point from last week. You had a paper out saying gold could go from, it's 1,900 today to about 3,000. What is driving that sentiment? And can you explain to us briefly why you've just turned, or why you've become even more bullish?
Well, look, I think gold competes, I'm oversimplifying here, but gold competes against interest rates. If interest rates are high, gold, which pays basically no interest rate, becomes less attractive. As interest rates vector towards zero, which they are now, then gold's relative appeal grows. It's really that straightforward. Now, what's hard for people to understand, I think, is it's not just the nominal interest rates or the interest rates you see on TV. It's real interest rates. And so real interest rates, as we saw in the inflationary cycles of the 70s, went to -4 or -5%. Just because of the math, you can't get there in a deflationary cycle. So right now, we have negative real rates of about 1%, and maybe they can get to 2%. But negative rates are still good for gold. So that's why we don't think it's going to be a blowout like the 70s, where gold would go up 4 or 5, 6, 7 times in a cycle. But we think rising 2 to 3 times in a cycle is completely reasonable, given that it's clearly in a bull market.
And Jan or Tom or Ben, anyone who wants to jump in here, is it fair for me to complain that the gold bugs keep trying to change the argument? It used to be it was good for inflation, and now Jan's making an argument it may be good for deflation too. Am I being boorish by pointing out that it's heads gold wins, tails gold win? I mean, can you really actually claim it's everything?
Yeah, well, I think you need to talk. Go ahead, Ben.
I just want to defend myself really quickly. I'm not always gold bullish. So we became gold bullish in the summer of 2019 when the technicals supported the Fed stimulus. And I will say on the risk side that higher rates will be bad for gold. The gold bull market will end when rates start going higher. Now, the Fed said we're not thinking about raising rates, so we think it's going to be a longer cycle. But that's the risk to the trade. So I'll turn it over.
Yeah, and just to add, we may be in a stagflation environment as well. When you think about the unemployment numbers, the low economic growth, and as Jan mentioned, with low interest rates and the potential for inflation creeping in, that all lines up. There are other stagflationary periods over time where gold has done really, really well.
Yeah. Ben, you've written about gold in the past in your blog. You've noted that gold tends to do better during periods when the dollar is weaker. Yet you've written about gold that the strong dollar is generally not good for gold. And yet this year we've seen a somewhat weaker dollar and gold's also outperformed. So can you sort of explain that, or is the dollar only a small component in what makes gold move? Looks like we're having trouble getting Ben. Anybody want to, jump in? Because Ben had
jump, Bob. One thing that I think we don't want to overlook is the pure supply and demand aspect of this. World Gold Council does a great job every month of being able to produce real reports about how much gold is being bought out there in the marketplace. It's not just central banks. It's not just individual investors like us. Jewelry demand continues to be strong in emerging market countries, and with that, that's also supporting the price. And ultimately, it's getting more and more expensive to get an ounce of gold out of the ground. And with that increased demand, we're going to continue to see the prices advance as well. So the fundamental and economic aspects of it, but definitely demand from an acquisition standpoint.
And Jan, can you address that supply issue that Tom brought up? Because it's obviously a supply-demand thing going on here. Tom said it's more difficult to get gold out. Is it because there's less gold to actually mine, or is it harder to get at? What is it that the supply is getting a little tougher to provide?
There haven't been major discoveries for many years now. That's number one. The amount of gold per ton of dirt is at much lower levels than it used to be. But I hate to quote my dad, but he used to say, all the gold that's ever been produced is sitting around somewhere. So at the right price, there's always enough supply to drive prices lower. So I tend to focus more on the relative attractiveness rather than the supply demand. But some of the factors that Tom mentioned are no doubt important.
Yeah. And one final thing to add there, Bob, if I could, the importance between investing in the spot gold price itself and then the miners, and then the difference between the miners. The large miners that we see in GDX are quite different than the junior miners. And during times when gold's advancing, there's a lot of pressure on those large miners to gobble up the smaller miners. So again, if you're diversified and you're looking to maybe participate in other ways with the advancement of the price of gold, junior miners tend to get gobbled up during these periods of time.
Yeah. And that's a key point about the difference between investing in gold and gold miners. Jan, you've got the gold miners, the GDX, and the junior gold miners. I guess with the key point being, aside from the issue about M&A activity, gold stocks are still stocks, no matter what you say and what anybody says, and they can still be subject to the vagaries of the stock market. I'm just trying to get you to make the distinction between investing in gold and gold mining stocks and how they can be somewhat different sometimes, depending upon even how people are perceiving the stock market in general. Could you just give us 30 seconds on that?
If you want to, gold, put differently, gold bullion is much lower correlation to the rest of your portfolio than gold mining stocks. That's for sure on a day-to-day basis. But if you're in it for total return, the gold miners generally will give you more return. The other thing that would worry me about gold, besides higher interest rates, is signs of a lot of froth in the market. And there have been a lot of inflows, but I will say that from what we see in the gold mining stocks, they're still far from froth that you've seen in other cycles. We got a long ways to go from what we're seeing.
Yeah. We were talking about limited supply. I'd done a special on gold, a big hour-long special, almost 10 years ago, 9 years ago. And at that time, the World Gold Council had mentioned to me that the total supply of gold ever manufactured would fit into 2 Olympic-sized swimming pools. That's a really good way of indicating how really limited the supply is. Think about this. The total supply of gold ever manufactured on Earth would fit into 2 Olympic-sized swimming pools. So it's really actually a remarkably small quantity. Ben, I think we've got you back here. You've written about gold in the past, and you've noted that the gold does not do well in periods when the dollar is strong, and yet this year the dollar's been fairly weak, and gold's outperformed. Any thoughts on that, or is the dollar only a peripheral in this particular circumstance?
No, I think actually if the dollar continues to fall, it could juice gold returns. So I looked at over the last 50 years or so, half of the years roughly the dollar increases, half of them it decreases. When the dollar rose, the average return for an annual return in gold was a loss of about 1%. And in the years when the dollar fell, gold was actually up around 18% for a year. So that is a really good dollar hedge. So we have these things like, you track real interest rates and inflation and all these things, but gold is actually a really good hedge against the falling U.S. dollar. So if the dollar continued to fall,
so your point is there's a very good correlation between the dollar and gold inversely. When the dollar is weak, gold tends to be strong. That was your point, right?
Correct. Yep.
Okay.